For weeks, it felt like everyone was on the same page. The markets, the Federal Reserve, things seemed predictable. But then, a single, unexpected economic report landed, and it changed everything. Let's break down what happened, and more importantly, what it means for the U.S. economy.
So yeah, that's the big question, right? How did one single data release, a report that, let's be honest, most people don't even follow, suddenly become the most important story for your money, for the markets, and for the Fed's next huge decision? Let's get into it.
Okay, to really get why this report was such a shock, you have to picture the scene just before it landed. Honestly, the financial world was sailing on pretty smooth seas. The consensus was crystal clear, super confident, and it was all pointing in one direction. The Fed was getting ready to cut interest rates. And look, this wasn't just some vague feeling or a guess. The market had actually priced it in with incredible precision. The expectation was for a full 65 basis point cut by the end of the year. You know, that's more than 2 standard rate cuts. This optimism, well, it was the baseline, the accepted truth. And then the data dropped.
All right, this is where the story really takes a sharp turn. The report we're talking about was the Producer Price Index, or PPI. Now, this measures inflation from the seller's perspective, the costs they're dealing with before anything even hits the store shelves. And the numbers that came in, they weren't just a little off. They completely blew all expectations out of the water. Just the headline number alone was enough to make Wall Street sit up and pay attention. The annual PPI, it just shot up from 2.4% all the way to 3.3%. I mean, that is a huge leap. It suggests costs for producers are climbing way faster than anyone thought. But believe it or not, that wasn't even the most startling part of the report.
No, the really crucial data point was the core number. This is the one economists watch like a hawk because it strips out those volatile food and energy prices. And it just soared to 3.7% annually, up from just 2.6%. This was a signal that inflation wasn't some temporary blip. It was broad, and it was starting to get embedded in the system. As you can imagine, the markets reacted instantly.
You just can't have an inflation surprise this big without some serious and immediate financial consequences. As traders and, their algorithms started digesting the news, this wave of repositioning just swept across global markets. And the chain reaction was immediate. First, the U.S. dollar got stronger, which suggests investors are now betting on higher for longer interest rates. Then, the 10-year Treasury yield, which is a key benchmark for borrowing costs for, well, everything. It jumped up to 4.30%. And that super confident expectation of a 65 basis point rate cut, yeah, that got revised down right away. It might seem like a small change on paper, but it was a massive shift in sentiment. So what was behind this sudden spike in prices? This wasn't just some random fluke. The data is pointing to one primary culprit that's been debated for months, but is now showing up clear as day in the numbers: tariffs.
For the longest time, there's been this big question hanging over the economy. Who is ultimately going to pay the cost for all these new tariffs on imported goods? Well, this PPI report seems to be giving us a pretty clear early answer. It turns out the costs aren't just staying abroad. They're starting to show up right here at home.
It really is a cascading effect. So when tariffs are first put in place, maybe the companies in the supply chain try to absorb that extra cost, to stay competitive. But that can only last for so long. Eventually, that financial burden gets passed along from one link to the next until it finally reaches U.S. producers and, ultimately, you and me, the consumers. And here's the real kicker. This data we're looking at, it's for July. That's before the most recent widespread tariffs even took effect on August 8th. What that suggests is that the inflation we're seeing right now, it could just be the opening act. The main event might not even show up until next month's numbers.
So all of this puts the U.S. Central Bank, the Fed, in a really, really tough spot. You see, the Federal Reserve has what's called a dual mandate. Their job is to keep prices stable and maintain maximum employment. But right now, the economic data is sending 2 completely opposite signals.
On one hand, you have recent employment reports showing some signs of weakness. That argues for a rate cut to help support the job market. But on the other hand, this new inflation data is just screaming for caution. I mean, cutting rates now could be like pouring gasoline on an inflationary fire. The Fed is literally being pulled in two different directions at the same time. So what happens now? Where do we go from here? Well, the Fed's next big decision is basically hanging in the balance, and the path forward is going to be determined by a whole series of critical economic reports and events coming up over the next few weeks.
Think of this as your roadmap for what's next. First, we're going to get some clues from Fed Chair Powell's big speech at the Jackson Hole Economic Symposium. Then, a flood of crucial data is coming our way. The PCE report, which is actually the Fed's favorite inflation gauge, another look at the job market, and of course the big one, the Consumer Price Index. All of this is leading up to the main event, the Fed's interest rate decision on September 17th.
And that brings us to the final critical question. The economy is basically speaking with two voices. One is warning about a slowing job market, and the other is shouting about rising inflation. In this battle of conflicting signals, which one is the Federal Reserve going to listen to? Their choice is going to set the course for the entire economy for months to come. And you can bet we'll be watching.